Hai, Assalamualaikum. My name is Nur Azian Atirah binti Muhammad Yusuf. So let's go to the question 1. First question for case 1 asks whether to choose setting up a branch or subsidiary in Malaysia. So first, branch is not a separate legal entity from its parent company. It is an extension of the foreign parent company, which means that the entity name and the activity of the branch must be same as that of its foreign parent company. The foreign parent company is liable for all debt and liability of the branch in Malaysia. Branch will not be entitled as tax resident of Malaysia and cannot be beneficiary of any tax exemption or government incentive available for other companies in Malaysia. While subsidiary is a separate legal entity from its parent company, the entity name and all business activity of subsidiary can be different from the foreign parent company name. Subsidiary is liable for its own debt and liability. A subsidiary also is considered a Malaysian tax resident and liable to local tax and entitled to various tax benefit and deduction. Branch and subsidiary are both good options. However, in this case, NewCo should choose setting up a subsidiary in Malaysia. This is because subsidiary is a separate legal entity from its parent foreign company, which means that they can engage a new name for its company. NewCo is a new company with a new name different from its parent recten. They are also liable for its own debt and liability. Since NewCo is a tax resident in Malaysia, they are required to pay the local tax and they are also eligible for various tax incentives and deductions such as pioneer status and investment tax allowance for its manufacturing promoted product business. Therefore, it is preferable for NewCo to choose setting up a subsidiary rather than a branch in Malaysia.
Assalamualaikum everyone. I would like to present question 1B and 1C. So B, whether to commence business during financial ended 31st December 2019 or 2020. So NewCo can commence during financial year ended 31st December 2020. It is because NewCo has 2.4 million as paid up capital. The estimated gross income is approximately RM 1 million per year. So, for year assessment 2019, the charge was 17% tax rate on the first chargeable income of 500,000 ringgit. And then the subsequent balance will be charged 24%. So, we will calculate with 500,000, we times with 17%, and then we plus with another balance 500,000, we times with 24%, which we can get total tax payable for year assessment 2019 was RM 205,000 ringgit. Then the year assessment 2020, the charge was 70% tax rate on the first chargeable income of 600,000 ringgit, and then the subsequent balance will be charged 24%. So the calculation will be 600,000 we times with 17%, and then we plus with another balance 400,000 times with 24%. So the total tax payable for year assessment 2020, we will get 198,000 ringgit. So different on both year, NewCo enjoy a saving of 7,000 ringgit. Okay, question 1C, the best tax incentive that can significantly reduce its tax liability after finish claiming investment tax allowance. State your reason. So the best tax incentive that NewCo can claim is reinvestment tax allowance. It is to assist a company resident in Malaysia since Recton is planning to set up a new company named NewCo in Malaysia. So NewCo can claim reinvestment allowance if they meet the eligibility of reinvestment allowance, which has been in operation for 36 months and more and has incurred in the basis period of for 1 year of assessment capital expenditure on a factory, plant or machinery used in Malaysia for a qualifying project. This is shown when NewCo has planned after 5 years to expand its manufacturing business where it meets the eligibility of claim reinvestment allowance, which has incurred capital expenditure. I think that's all for me. Thank you.
So we continue with question 2 that asks for advice Pamka on disposal of its machinery in terms of timing. Since some of the machine will have to be sold at a loss, therefore the company will be obtain balancing allowance. So Pamka should dispose the old machine of 8 year and on 31st March 2020 instead of following year in order to obtain balancing allowance to shelter adjusted income for current year.
Assalamualaikum, my name is Muhammad Aman bin Muhammad Siddiq and I will continue with the presentation of question 2B. Advise Pamka on how to save tax on disposal of the stamping machine. To save tax on the disposal of the stamping machine, Pamka should be aware about the timing of the sale, which is minimum of 2 years required in order to avoid the clawback of capital allowance by the tax authority. So, Pamka should sell the stamping machine by the next financial year, which is ending on the 31st March of 2021. Next, let's move on to question 2C. State whether Damco Group of companies can make use of group relief to reduce tax liabilities in years of assessment 2020 and 2021. With effect from YA 2009, 70% of the current year business loss of a surrendering company can be surrendered to its related companies, which is the claimant company within the group. There are few requirements need to fulfill in order to enjoy the group relief. First, claimant and surrendering companies must be resident and incorporated in Malaysia. Second one, claimant and surrendering company, each company paid up capital must be more than RM2.5 million ringgit at the beginning of year assessment, and both companies must have the same accounting period. Claimant and surrendering company must be related companies. Related companies means that at least 70% of ordinary shareholding is either owned by a surrendering company or claimant company or commonly controlled by another Malaysian resident company, and must be related throughout the relevant basis period as well as the 12 months preceding the basis period. So, Damco Group of companies cannot make use of the group relief to reduce tax liabilities as there were unfulfilled conditions to use the group relief, which is Pamka Sdn Bhd paid up capital is RM2.3 million ringgit, which is lower than the amount required, which is RM2.5 million ringgit, to become eligible for the group relief. As Pamka is the surrendering company in this case, the non-fulfilled requirement automatically denies the chance of Ruba and Damchi to become the claimant of the group relief. Thank you.
Assalamualaikum. Hi doctor and everyone. My name is Nur Asmida Ayuni binti Abdullah. So now I will explain about question 2D. The best method for Ruba to finance its purchasing of the new machineries is by using the long-term loan methods. First, it would be beneficial to Ruba rather than using the leasing method. This is because Ruba will be entitled to claim investment tax allowance, which are initial allowance and also annual allowance. For the first year, Ruba will be entitled to claim initial allowance and annual allowance on full qualifying expenditure. For the subsequent years, Ruba will be entitled to claim annual allowance until full relief is given to the qualifying capital expenditure. And then by using long-term loan, the loan interest will be allowed as a revenue deduction. Okay, let's proceed to the next question, which is question 2E. Okay, in this case, Damchi is a most profitable company. So, Damchi should take over TSG Sdn Bhd by merge with TSG. Because it will, this is to utilize unabsorbed capital allowance with unabsorbed tax losses. And then, Damchi and TSG Sdn Bhd also have the similar nature of business, so that the profitability of the new business would be able to utilize unabsorbed capital allowance from existing business and utilize unabsorbed business loss from any businesses. The second one is Damchi should not take over dormant company, which is KY Sdn Bhd, because if there are any significant changes in shareholdings, unabsorbed losses cannot be transferred to the new owner, which is Damchi Sdn Bhd. And then the question is asking about the method of acquisition. So in this case, Damchi should take over TSG Sdn Bhd by shares. The first one is because the main advantage of acquiring by shares is the tax attributes such as unabsorbed tax losses and tax incentives will remain with the target company, which in this case is TSG Sdn Bhd. However, Damchi will expose to liabilities and exposure in TSG. So, Damchi shall carry out due diligence exercise on TSG business in shares acquisition compared to an asset. Furthermore, acquiring by shares will allow TSG Sdn Bhd to continue enjoying the tax incentives, which is pioneer status. Other than that, transfer of shares are capitals, hence it is not taxable. Other advantages of acquiring by shares is no capital allowance or balancing charge clawbacks on the seller. And then buyer, which is Damchi Sdn Bhd, may be able to use and benefit from unused tax attributes and tax incentive from target company, which is TSG Sdn Bhd. And the last one is when acquiring by shares, there will be lower stamp duties payable compared to physical assets. Thank you. That's all from us.